Imagine waking up to find $32 billion has simply vanished into thin air. One day you are the king of the world, and the next you are the face of the biggest financial crime of the century. This is not a story about a bad trade or a market dip. It is a story about how a math genius in cargo shorts convinced the world he was a saint while running a global shell game. How did the smartest people in the room miss a massive hole in the balance sheet until it was too late? Stick around, because what we found at the bottom of this rabbit hole is even crazier than the headlines. By the end of this breakdown, you will see exactly how the world was blinded by the promise of easy money. Sam Bankman-Fried did not just want to be rich. He wanted to save the world by making as much money as humanly possible. He walked into meetings with top venture capitalists while playing video games on his laptop. The market saw this as a sign of a genius who was too busy thinking about the future to care about optics. In 2019, the crypto world was a wild west, and everyone was looking for a hero they could trust. FTX appeared to be the adult in the room, with a clean interface and a founder who talked about giving everything away to charity. The industry believed that Sam had cracked the code to risk management. But while the world saw a revolutionary exchange, something was already starting to rot behind the scenes. The line between his trading firm and his exchange was not just blurry, it was practically non-existent. From the very first day, investors thought they were backing the next Goldman Sachs of the digital age. Insiders felt like they were part of a movement that was going to replace the global financial system. But the reality was that they were building a house of cards on a foundation of their own printed tokens. This moment locked FTX into a path where they had to keep growing, just to keep the lights on. If you find these deep dives into business psychology valuable, you should join our community of strategic thinkers. We break down the biggest wins and failures in business every week, so you can spot the patterns before everyone else. The strategy for growth was simple on the surface, but incredibly dangerous underneath. FTX used its own native token, called FTT, to manufacture wealth out of nothing. Think of it like a casino printing its own chips, and then telling the bank those chips are worth billions in real gold. They used these printed chips as collateral to borrow real customer money. This looked smart because as long as the price of the token went up, the company looked infinitely wealthy. The assumption was that the market would never stop believing in the value of the FTX brand. But when the value of the token started to shake, the entire loan structure began to crumble. It was a feedback loop that worked perfectly on the way up, but turned into a death spiral on the way down. Between these steps, there was a constant need for more celebrity endorsements and stadium naming rights. They spent hundreds of millions of dollars on marketing to make sure no one looked too closely at the books. If the public sees your logo on a basketball arena, they assume your math must be correct. It was a masterclass in using prestige to mask a total lack of transparency. Does a massive marketing budget make you trust a company more, or does it make you wonder what they are hiding? Let me know in the comments if you think aggressive advertising is a red flag for a startup. The numbers coming out of FTX during the peak were absolutely staggering. They were reporting billions in profit while other firms were struggling to survive the crypto winter. To investors, these numbers felt like proof that Sam was a once-in-a-generation talent. The growth was exponential, and the FOMO was real for every major venture capital firm in Silicon Valley. But behind the scenes, the losses were being moved to a secret account that was shielded from the auditors. Every time the market dipped, they used customer funds to bail out their sister company. The tension between the public valuation and the actual cash on hand was reaching a breaking point. The investors kept saying yes because they were terrified of missing out on the next big thing. They traded due diligence for a seat at the table of a $32 billion giant. The shocking reality hit when a single balance sheet was leaked to the public. It revealed that the empire was not built on dollars, but on a token that FTX created themselves. Confidence collapsed in a matter of hours as users rushed to withdraw their funds. The uncomfortable truth was that the money was simply gone. It had been spent on real estate and bad trades and political donations. The entire story was not about a business failure, but about a complete betrayal of trust. Was this collapse avoidable, or was it destined to happen? From the moment they printed their first token. Tell me who you think is more to blame, the CEO who lied or the investors who did not check the math. There are a few powerful lessons we can take away from this wreckage. First, never trust a business that uses its own stock or tokens as collateral for loans. Second, if a founder acts like they are too smart to follow basic rules, they probably are. Third, when a company grows too fast without any oversight, it is usually a sign of a looming disaster. Smart people missed this because they wanted to believe in the myth of the genius founder. You can spot these patterns early by looking at how a company handles its transparency during a downer. These ideas apply far beyond just the world of crypto and finance. If you enjoy real business stories like this, you might want to subscribe to the channel. We have more deep dives into the strategies and failures of the world's biggest companies coming your way soon. Hit the notification bell so you never miss a breakdown of how the business world really works. Would you have seen the red flags at FTX, or would you have been caught up in the hype like everyone else?